Joining us now is Stephanie Link, Hightower Advisors Chief Investment Strategist and a Meta shareholder on set. Great to have you.
It's great to be here.
So, I mean, you're a Meta shareholder. We just saw, fresh high. Stock finished up 3% right now. Do you still like the name?
I still do like the name, but I have been trimming. A year ago, the stock traded at 7 times EBITDA. Today, it's trading at 19 times, so it's totally re-rated. And I get why, because it has gone from a cost-cutting only story, right, the year of the efficiencies, to actually now a revenue reacceleration story, right? They're doing very well with Reels. Reels has a $6 billion revenue run rate now, right? Click-to-message, a $10 billion revenue run rate. I mean, these were nowhere a year ago, right? So, and then, of course, you do have this huge install base. And now if you do have this new competition to Twitter, that might be something else, not to mention WhatsApp. They can monetize that, too. So I like it, but it's had a nice run. So I have been trimming it, but I'm going to hold it. It will be a core position for sure.
Got it. I mean, it's pretty amazing. The stock has more than doubled since the start of the year. And to your point, I mean, you have seen this stabilization, maybe even signs of recovery in online advertising more broadly right now. So if you're trimming Meta, what are you buying?
Well, I'm buying different things because I think for the rest of this year into 2024, I actually think you're going to see a broadening out in the market. You guys have been talking for a while now. From the beginning of this year, you've had a very narrow market. And I think that was because there were a lot of unknowns. And I think we're slowly chipping away at the unknowns, meaning debt ceiling, bank crisis, even the Fed. Even if the Fed goes 2 or 3 more times, you're in that 9th inning of this rate cycle. And that's good. Now, that doesn't mean they're going to start cutting anytime soon, so rates are going to stay high. But at least it's an unknown that becomes known, and we can model around it. And at the same time, the economy has stayed pretty resilient. The consumer, housing, auto, services, really strong. Manufacturing, not so much. I know you cover the industrial space very well, as do I, so we can talk about that. But manufacturing has been kind of the problem, offset by onshoring. So I think you have these puts and takes in the economy, but it's doing better than expected, better than feared. And so I think the cyclicals can actually start to outperform. And we have been seeing a broadening out over the last couple of weeks. So I kind of want to diversify. So I bought Home Depot because it's lagged. I mean, some of the housing stocks you've seen, they're 30, 50%. So I bought Home Depot. It's up 1, right? And they have a great algo. 3 to 4% total revenues, margins expanding, productivity initiatives. And oh, by the way, their total addressable market is $950 billion. So I bought a little bit of Home Depot. And then I bought a little bit of Zimmer because I think after the United Healthcare reported and updated numbers, as did Humana, they talked about higher utilization rates.
Okay.
That's good for med tech, right? We want utilization rates and the non-essential surgeries to do better. So this benefits Zimmer, and I like Las Vegas Sands. I think that story is in the 2nd or 3rd inning in Macau recovery. So I'm finding a lot of stuff, not so much in tech though, in other places.